From today, 21st January 2026, the European Union ban on refined products made from Russian crude is expected to create further reshuffling of trade flows. India and Turkey have sharply reduced Russian crude intake, replacing barrels with Middle East and US supply. Compliance uncertainty is already diverting LR2 cargoes away from Europe, lifting ton-mile demand but raising execution risk. Falling Urals prices have reopened price cap-compliant routes, pulling EU and G7-linked tankers back into Russian export trades. Nearly one-third of Russia's seaborne crude is now moving on compliant tonnage. However, Black Sea security risks and tighter EU enforcement leave this window fragile. India's crude imports from Russia dropped to a 2-year low in December after new US sanctions, pushing OPEC's share above 53%. While Russian flows are expected to stabilize, barrels are increasingly redirected toward China. Tankers, this supports longer Pacific voyages and keeps VLCC utilization elevated. Venezuela has record crude volumes on water as US-supervised licenses redirect barrels away from the shadow fleet. Cargoes are staging in the Caribbean before moving to the US and Asia on compliant Aframax and VLCC tonnage. This structurally supports mainstream tanker demand and displaces lighter US barrels into export markets. Despite heavy fleet growth, tanker rates are expected to stay firm in 2026. Sanctions on Russia and Iran, the reintegration of Venezuelan barrels, Iran tensions, continuation of Russia-Ukraine war are inflating uncertainty, trade routes, and ton-mile demand.